Welcome back, everyone, to Noble Gold's live stream. I have Micah Haynes and Josh Ward here. We have a lot to go over in terms of stocks, the bond market, gold, lots to cover, lots to go over. It's going to be an exciting day. Looking forward to it, guys.
Great. Yeah, Josh, thanks for having me on. It's been a pretty busy week for us, hey?
Yeah, absolutely. Yeah, a lot going on, a lot to go over. Where do we start?
Yeah, well, look, I think there's a few things to cover. I mean, since Liberation Day, it's just been all out. It's just, there's a lot of unprecedented stuff going on here. And I think what's really important to emphasize is a few key themes for our investors, clients, both prospective and existing. I want to cover some very, very, very important subjects today, just with respect to where we are in the markets and where we're going. And so I've prepared a bit of a chart deck for us. I want to talk about a few things. So really since Liberation Day, Josh, as you know, it's just been volatile. That's the one word that I would use to describe it. So a lot of erratic things happening in a few key markets. And I want to start with the dollar today, if we can. You're very familiar, Josh, with the Dixie, right? The DXY. This is a chart of the US dollar's relative strength compared to other major currencies, okay? Like the euro, the pound, these types of things. This is a longer term multi-year chart, but I've drawn a line across the bottom there where we are right now. We're at a strategic pivotal moment in the dollar right now at around 100. Okay, at the present time, we're at 100 on the relative strength index for the dollar. But let's look at the far right side of this chart. See that straight line down? That's all in the last week, Josh.
Yep.
This is a move that's unprecedented to the downside. This is not good. This is not good for the US dollar. We've gone from roughly 104 to 99 in the US dollar index in about 1 week. So that's a 5% drop in the overall strength and purchasing power of the US dollar in a week. Normally, it would take us months to see this kind of decline. But with trade policies, various things that are happening in the bond market, what we're seeing right now is a flight to other currencies. The euro in particular is strengthening, but we are at a line in the sand when it comes to the dollar. This area has been tested before, but look at that line. You can see it's always gotten to the 100 level and it's just bounced, right? It's bounced up. 100 kind of seems to be a little bit of a floor, but I actually think we're falling through that floor right now, Josh. And this just does not look good for the US dollar for the short, medium, and long term, frankly. On this next slide, I just have a little bit of a projection here as to where I think we're going. The size of the breakdown that we saw last week is something that I think we're going to probably see again here in the coming weeks. We're in a pennant right now, that triangular formation. We're kind of hovering around that 99 to 100 level on the Dixie. Once that floor, that line that I've drawn, breaks down, we're probably going to see another 5-6% drop down into the 94, 95 range on the Dixie, which just means, you're losing money if you're holding dollars. Now, we'll get into the stock market in a little bit. You're very familiar with how the stock market's performed for the year. Just generally speaking, depending on what you own, you're down anywhere between 15 and 20%. But a lot of our clients, both new and existing, are actually holding on to quite a bit of cash, right? They might want some more metal. They're unsure. They are out of the stock market. They don't know what to do. A lot of clients right now calling us that are new prospective clients are saying, I'm holding all these money markets. I'm holding on to dollars. Sure, look, that's better than being in a market that's dropping. But you cannot ignore the fact that the dollar itself is a risk. Holding the dollar is a risk over the long term as well. One stat that I like to share with clients is with the rate of inflation right now, Josh, we're seeing a decline of about 8 to 10% a year in terms of your total purchasing power. Okay, and a thing I like to highlight to clients is that the half-life of the dollar right now is every 6 years. What that means is 100 grand in cash today will buy you about 50 grand worth of goods in 6 years. Another 6 years after that, it buys you 25 grand worth. Another 6 years after that, 12,500. Okay, holding on to cash for the long term in light of this setup in the dollar relative strength index is not something you want to do for longer than you need to just figure out what the next move is. Okay, so we need to be very cautious with cash. And just any take on that? I know you're very familiar with this stuff too, but do you have anything to add to that?
Yeah, something. I mean, just it's remarkable to me is just in the first quarter of 2025, we've seen depending on what metric you look at or what market you look at, we've seen a 10 to 20% decline in the stock market. In the same time, we've seen about a 25-30% increase in gold. So priced in real money, we have a 50% swing from the stock market to physical gold. And this is, I can't remember there being a quarter where we saw this big of a turnaround. I think it's unprecedented. I read an article the other day where we have, gold had the best quarter. The Q1 of 2025 was the best quarter gold's had in 40 years.
Wow.
And that's really just telling, right? It's flashing signals to the market, to the economy, to the world of what's really going on here. We always got to watch gold. Gold is kind of the canary in the coal mine, I like to call it.
Absolutely. And you're right. In 40 years, the last time it did this well was back in the late 70s, early 80s.
Yes.
And, from 1974 to 1980, Josh, gold went from like $42 an ounce to $800 an ounce.
That's correct. Yeah.
That was the last time that we experienced something that's called stagflation as well, right? It's where you have a contracting economy, but the price of everything continues to rise. So the things that you need, from gas to food to shelter, those things are going up, but jobs are slowing down, the economy is producing less. And when you have that type of combination, which is quite frankly very rare, like we haven't had a stagflationary macroeconomic setup since the 70s, we're now in that same type of macro backdrop. So, gold went from 40 to 800 in 6 years. Okay, from 78 to 80, from 1978 to 1980, it went from $100 to $800. It's like an 8-fold move. So yeah,
in a few years.
A couple of years. So for us to go up, 20% in 3 months, again, is telling. It's a canary in the coal mine. It's telling you there is something that is structurally and fundamentally wrong with the global economy, the global financial system, and we're going to get into that a little bit more. So one of the other markets we really need to touch on is the bond market. This next slide, it seems a little bit complicated, but I want to walk you through this. So when you have rising yields, meaning the interest rate on our bonds, when those are going up, people want to buy bonds and hold dollars because you're getting a better return. Okay, so when you see the blue line, which is the yield on a treasury note, when they go up, the dollar goes up. You can see that, especially for the last few years, but even further back, this is the case for the last 20 years. When yields go up, the dollar strength goes up. And so you see that the blue line and the red line are actually tracking each other very, very closely throughout the highs and the lows and the changes in the yield in the bond market. But what's happening right now is extremely rare and very concerning. You're having a decoupling of the strength of the dollar and in bond yields. So the red line is the dollar strength. The blue line are bond yields. You never have a decoupling like we're seeing now unless there's something fundamentally wrong with both the bond market and the dollar. And I want to explain this in a little more detail, why this is happening, but it means that our interest rates and the interest that we pay on our debt is going up, but your dollar is also becoming much, much weaker. Now, these things normally go in tandem, right? Like they move up and down together, but this decoupling is actually an even bigger canary in the coal mine than the price of gold shooting up, but they're all tied together. We're going to put a bow on this in a little bit, but it means that people are selling dollars because they don't want to hold them, because they know that the writing is on the wall about, the dollar trajectory being down. But when you sell dollars, the way that countries mostly hold and have exposure to the US dollar is by holding treasuries. But when you sell bonds and the price goes down, it spikes the yield. And I've said this many times, and I'm sorry if I sound like a bit of a broken record, but think of it as a seesaw. If the bond price is high, because people are buying it a lot, you get a low yield or a low interest rate. But if people are selling bonds like crazy, the yield goes up, the interest rate increases. Well, right now we're clearly seeing countries like China and Japan and other trading partners that are very concerned about the trajectory we're on in this trade war that's frankly just been paused and on and off, but there are escalations with few key trading partners like China, where they are dumping treasuries at spiking yields. But this time the dollar is actually not participating in that increase. The dollar's going down. So this again has kind of a double whammy effect. Your dollar's not going as far, and as far as everything goes with respect to yields and interest rates, it's going up, and that's going to hurt everybody. That hurts everyone on mortgage rates. That hurts everyone on credit card rates. That hurts the government in terms of what we're going to be paying when we roll over a whole whack of debt that we need to roll this year. It's about $9 trillion is what the U.S. government has to roll this year, and we're going to get into that a little bit more. So this decoupling, unheard of, unprecedented, very scary, and again, it's reflected like if they're not holding dollars and they're not holding bonds, what are they doing? Well, they're buying gold. It's obvious. So this is the yield on the 30-year Treasury bond. Okay, so you can see again, just in the last week or so, it went from 3 to 4.9. Okay, that's more than a 10% increase in the actual yield. Okay, that again, the nature of this spike is obviously because of extreme selling of these bonds. The price is being liquidated, the yield is spiking. That seesaw, which kind of works in in opposites, is just going like this. Okay, the bonds are being sold, the yield is spiking. Let's look at the 10-year, which is what this next chart, which is what most commercial and even government debt is based on. It also went from about 3.9 to 4.5, another 10% jump in just a matter of a week. Okay, what people don't maybe realize is that that's 10% jump in the yield on the 10-year just cost the U.S. government $350 billion more in annual interest. Okay, this is a problem. If our trading partners and the rest of the world see the U.S. dollar as a liability, and they continue to sell bonds and yields continue to spike, well, we are rolling over, again, $9 trillion worth of debt. That's going to cost us an arm and a leg to do so, okay? So another very, very concerning development here in the bond market. And
so something to note too, Micah, is that this is making home loans go down, interest rates go up for home loans, which is negative on the economy, right? As we see the treasury bonds go up, so do interest rates, right? So does the cost of borrowing, right?
Exactly. So and you and I covered just last week, Josh, like mortgage applications are at a 20-year low.
That's right.
This is not helping that situation. No. So with housing prices still remaining quite high, in most markets, we did talk about a lot of the housing markets that are seeing a glut of inventory. People want to sell. Some home price revisions down, 30% in different parts of the country, like Florida, some in Texas. This is just not going to help, right? We've got an even more illiquid buyer in terms of anything that requires any kind of debt. Of course, housing and real estate are the big part of that, big sector that's impacted by that. So very bearish for the housing market. Let's now turn to this next slide here, which of course is going to be on, I think, everybody's mind, is the stock market. So we've got dollar down, bonds down, yields up, and stocks down. So this chart might seem a little technical, but I just want to walk you through it. So I've highlighted 2 red sections. This is something that's referred to in technical analysis as the death cross. And that's when the moving averages, so you've got that purple line, which is the 50-day moving average. So it's a moving average of the price over the last 50 days. And obviously it goes up and down, but it more or less is a predictive kind of directional instrument. And then you've got the longer 200-day moving average, which is always a little bit lower because it trails on a longer time frame. Well, when you get the 50-day moving average crossing down and going below the 200-day moving average, it's referred to as the death cross. And the reason that is because it means that the market's headed down over the medium term, short term and medium term. So the last time we saw a death cross in the S&P was back in 2022. Okay, and you remember how busy we were then. Yes. People were down 20 to 30% that year. Okay. Now, not to say it didn't recover, but it was a very volatile year for both stocks and bonds. Well, we're seeing that now, okay? But this death cross is only happening this past week. We're already down, you and I mentioned, anywhere between 10 and 20. I say 15 and 20, depending on what you're invested in. So far this year, we're down by 20%. If you draw a line from the low at, let's say, 5,000, and today we're at like 54, take that across the chart, we essentially have wiped out all of the stock market gains in the last 3 months. We've wiped out all the gains from the previous year. Okay. So 2023 was a great year for stocks, up by 20%. 2024 was a great year for stocks, up another 20%. 2 consecutive 20% years is almost unheard of, right? Like annualized returns on the stock market should be 5 to 7%. Going back hundreds of years, that's what you see. But we had 2 amazing years in the stock market. Well, it's gone. The blink of an eye. Everything that we saw in 2024 is gone now.
3 days, the stock market trading for 3 days, a year's worth of gains gone.
That's it. So, what I don't understand is we're technical guys. We live and breathe this stuff. We follow finance, we follow stocks, we follow stuff because it's instrumental to our business. We can take it for granted that we live in this space. Most of our clients don't. They got families they're taking care of. They're going to their jobs. They've got busy lives. I get that. That's why they want to listen to us. That's why they want to know what the key areas are that they need to pay attention to. These few that we're covering this morning are them. But what I don't understand is, sure, we're steady, right? We're steady right now. But if I can be a little bit, blunt here, we are nowhere near as busy as we should be because American investors are still focused on the stock market. Okay, we have a 15 to 20% decline. It's probably about half of where we're going to end up at the end of this year. I suspect we're going to be somewhere down between 35 and 45%. Okay, and knock on wood, I don't have a crystal ball. We can come back on and do a review later this year, but my guess is we finish the year with the general stock market being down between 35 and 45. So we're halfway there. This death cross, which is happening now after 3 months of the stock market correcting, is really only this is kind of saying things are only just getting started. Like the decline in the stock market is only starting as of now on a technical basis. So if we bring up my chart, I want to just walk you through a couple of different things which show you that we're nowhere near the American stock market kind of reflecting the amount of danger that's actually present in the stock market. So this, just as an example, are the S&P 500 companies' earnings. Okay, they've been revised down to the lowest point not seen since COVID, when we had an economy that was entirely shut down for months on end. So the S&P is now revising earnings to the lowest point in over 5 years, and yet people are pouring into the stock market like crazy. And I'm going to prove to you that that's what's happening. Let's go to this next chart. So, and then we might just have to, I want to touch on this. We've talked about the swings, right? The swings in the stock market have been crazy. We had 3, 5 to 6% down days. We had one day last week where the stock market was up 10% in a single day, just to lose it all within the next 2 trading days. So the stock market, which is normally as steady as she goes, you get your 5 to 7% annualized. Right now, it's a yo-yo. It's up, it's down, it's just, it's not the same. It's crazy. And it actually has right now on a volatility chart, what this shows you is orange is the volatility of Bitcoin, okay, which we know has had crazy swings, crazy up, crazy down. You expect that from Bitcoin. It's a little bit more of a speculative market. It's smaller. It's not, seeing tens of trillions of institutional money flows, right? It's not the U.S. stock market. But the white line is U.S. stock market. It has the exact same. They're now on par in terms of their volatility in 2025. They are both trading like yo-yos, okay? That is not an environment in which you should leave your 401k or the bulk of it or your retirement account or your Roth or your IRA or anything like that. So it's just crazy to see the types of moves that we're seeing in the stock market, which should be a generally quiet and confident market in good times, which of course we're not in. But this next chart, sorry, I'm going to catch my breath here, is showing you retail investor inflows. Where are retail investors going right now? Well, because of their financial advisors, we can talk about this a little bit. All they ever do is recommend the stock market. Doesn't matter how much blood is in the street. Doesn't matter how much volatility is there. It doesn't matter what's happening with bonds or with stocks. Most financial advisors are always going to recommend hang on, sit tight, put more cash into the market. Time in the market's better than timing in the market. And while that's generally true, there are certain setups that are just red flag after red flag after red flag. Despite all those red flags, retail investor inflows are still now just pouring in at record levels into the stock market, like lambs to the slaughter, in my opinion. Okay. We should not be seeing more money pour in after a 20% correction when all of the things show you that this is just the start of a larger, maybe multi-year bear market. This isn't necessarily a 20% down and then back to all-time highs and forget about it, you're good. No, it's being treated that way, but we're actually coming into a structural, fundamental, global financial system change that is actually now probably the beginning of a larger, deeper correction, kind of like a 2008 or worse. But what are investors doing? They're asleep at the wheel. They're pouring in to stocks like there's nothing wrong. Like none of these red flags are up and waving right in front of their face. And maybe they're not paying attention. And I don't mean to sound disrespectful, but they're just not reading the signs, or they're not being given the proper advice.
Yeah, and that's kind of par for the course here, right? I mean, I've in the years that I've been doing this, I've always noticed that, you know, people tend to crowd a trade when it's going up, and they tend to leave a trade when it's going down, right? So the
investor sentiment, right?
That's
Follow
exactly
the crowd.
right.
Follow the crowd.
That's exactly right.
But if everyone's driving off a bridge, you know, my dad always said, like, just because your buddies are jumping off the bridge doesn't mean that you should, right?
No.
I think part of it is like a fundamental kind of systemic error with the way that like financial planning is done. Most people buy 70 or 60% of stocks and 30 or 40% of bonds, and you set it and you forget it. ETFs now are more popular than ever before. Passive investing accounts for, you know, a very large portion of the total stock market. Active investing and actually, you know, stock picking is almost a dead profession, right? But people are being, again, led like lambs to the slaughter, saying, hey, look, the market might crash next year, but just wait it out, ride it out. It'll always come back. Well, Josh, there are periods, as you know, where the stock market can do nothing. It can go down or sideways for 10 or more years. Like the NASDAQ in 2001 crashed. It didn't do anything or recoup its high from 2001 till 2013. Okay, that's fine if you're 25 or 30 or 35. But if you're 60, you are lining yourself up to have your portfolio obliterated by half and stay that low for 5 or 10 years, which you probably can't afford to do if you're relying on that income, right? Like I got lots of clients who pull a little bit of money out every month, every quarter, make ends meet on top of Social Security, and that's okay. Like that's what retirement's for, right? Is to help you make ends meet and to live a great quality of life in your retirement years. Well, I'm sorry, but if you are strapped in, buckled up, and headed into a collision, like this is actually like a kind of a disaster scenario, you are really setting yourself up for some major pain. Yeah. Major pain when you're down by 30 or 40%, like I predict by the end of the year, and maybe worse. And then you've got to wait how many years for that to come back?
That's right. I mean, investors, I think, have a short window right now to take the gains, take some chips off the table in the stock market, and convert it into an asset that is, you know, historically more undervalued, historically does better in these types of environments, right? Yeah. You're not stuck in the stock market, right? Everyone thinks that you're stuck in the stock market and you have to ride these waves out. And that's not the case.
Absolutely. And I think, look, nothing against financial advisors. And of course, we're biased, right? We're both precious metals investors, have been for a long time before we ever even started working for Noble Gold Investments. Okay. Like I've been buying for 8 or 9 years. I've been working here for 4. Yeah. I live and breathe this stuff. I love it. I'm an investor first, sales guy second. And I tell people, look, there is a bias. I work for a gold company. I'm invested in this stuff. I walk the walk. I talk the talk. Of course, I don't have a non-bias, but I am trying to give you all the facts and backing it up with data, backing it up with charts. But financial advisors, they don't want to sell you anything that they can't profit off of either, right? So when you go to your financial advisor and ask them, hey, I'd like to, put a little bit of my portfolio into gold, they're going to look at you and say like, what? Like, what are you talking about? It's like going to a Chevy dealer and asking them what kind of Ford you should buy. Okay. They're going to tell you they can't, you shouldn't, and all these other reasons why. You don't ever recommend that somebody buy something you can't sell.
That's right.
But regardless of whether it's Noble Gold Investments for physical precious metals IRA or any other type of metals investment that you can get your hands on. Diversification and protection for your portfolio into the precious metal space is an essentially important question that you have to ask yourself. Like, how much? That's a question for each person, case by case. We work with clients to figure out what makes the most sense for them. But you cannot ignore this space. It cannot be ignored. And unfortunately, most people won't realize what's happening in terms of like the big macro shifts and where the stock market's going, where the economy is going, where the metals are going, until it's a little bit too late and they've already lost 20, 30, 40% of their portfolio.
Yeah, that's right.
So
something to go over too about the advisor point. So a lot of people don't understand this. So how financial advisors, money managers make money is a percentage of assets that they have under management. They get paid out, right? If you do better, they do better. And then some of them have a set fee. But anyway, it's usually anywhere from 1% to 2% that you're paying of the account value every single year to a financial advisor, right? When you buy gold and silver, you pay a one-time commission and the gains are yours forever, right? It's not like you're paying Noble Gold every year to make sure your gold stays gold and your silver stays silver, right? There's no management fees. There's no 1%. There's none of that here on an annual basis, right? Which is something that when our clients talk to their financial advisors, they never hear that it's a good idea to take money out of the advisor's pocket and put it into gold and silver, right? So there's an extreme bias there. And I've talked to hundreds, thousands of advisors over the years, and I have yet to meet one that thinks buying gold and silver is a good idea. They didn't think it was a good idea at 1,000. They didn't think it was a good idea at 2,000. They don't think it's a good idea at 3,000, right? I mean, it's like it's a broken record.
Exactly. And I think I saw this stat, and I wish I had a chart to back it up, but something like the total percentage of gold holdings in American portfolios right now is less than half of 1%.
That's correct.
It's insane.
Yeah, most gold people own is on their wedding band, and that's it.
Right. But in 1980, gold had a total global portfolio allocation on average of 8. So to go from 0.05 to 8 is a 16 times multiple in the market cap. And we're probably going back to that. I think, again, China selling bonds, dropping dollars to buy gold, which is one of the main reasons why it's driving the price up so high. Yeah. We're early days. $3,000 gold is nothing compared to where I think we're going.
And that's retail, right? What are the central banks doing, right? How have their positions of gold and silver gone up over the last in the same time frame, right? I mean, central banks are loading up on gold and silver all over the world, from China to Russia to even here in America. We're seeing a huge rush to gold, while the retail investors are going into the stock market or selling their gold, right? I mean, I remember mentioning this to you the other day, right? I talk to, gold and silver buying coin shops all over the country. And, they're telling me that it's a 10-to-1 ratio right now, which is mind boggling to me. So for every 10 people that come in there to sell, one person's coming in to buy.
It's outrageous. And our ratios aren't as high because there's a lot of education that goes into why you're buying your metals and for what kind of time horizon when our clients originally come in. But we see a lot of selling now too. Look, gold is at all-time highs. It seems like a good idea and a good time to sell. But the price action that we talked about, like gold is $2,500 at Christmas. It's $3,200 now.
That's correct. Can you imagine if you sold at Christmas? You think, hey, I'm just going to, it's at close to all-time highs. I'm going to sell. I'm not going to worry about it. You get back into the market. But you're down 20% in the market while gold's gone up 20, 30% in that same time frame.
What's driving that is governments, central banks, billionaires, hedge funds, and all these other large institutional buyers. This smart money, if you will. Okay. And I'm not calling retail investors dumb or dumb money, but frankly, watch what they do, not what they say. If you listen to what they say, they want you to think gold's a barbarous relic. No yield, no nothing. No, it's not a business, no earnings. Okay, fine, but it's considered money. It's a tier 1 asset going back 5,000 years. There's a reason that everyone is buying this. Everyone with money to protect, they're buying it because the writing's on the wall that the plumbing of the financial system globally is about to change. Whether that's the gold revaluation happening from the U.S. government or some BRICS currency catalyst. They want to own gold because it is money. It will always hold its value. Currencies, as we know, are depreciating like crazy, US dollar included. And long-term debt is not something you want to own when we're going into a massive recession and probably a sovereign debt crisis, not just for the US, but for the whole world. And so, the idea that we're probably going back to some type of global gold standard, which, by the way, we were on prior to the Great Depression, right? The only reason that every single country came off the gold standard in the 1930s is because they needed to print money to stimulate their economies during an insanely difficult economic time. So they were constrained by a gold chaperone to their money supply. They came off it so they could print, and put it all into the markets to be able to sustain. But now it's the opposite. We've been on a fiat system globally. Every single country in the world is on a fiat currency system for the first time really ever, right? These last 50 years, it's the only time in history it's ever been done. And now everyone's going back to gold. Why? Because we're probably going to have a sovereign debt crisis that's fueled by a currency crisis when they print so much money. You have no idea where inflation is going in a few years. And when it all blows up and gets reset and there's a debt jubilee or whatever it is where everyone gets back to par, they clear the decks of all the debt and they reestablish a new world order, not to sound like conspiracy theorists, but that's where this is going. Gold's at the center of that. Okay. And then again, watch what they're doing. Billionaires, financial institutions, hedge funds, banks, governments, and central bankers, central planners are all buying this stuff. Yet retail is being herded into the stock market like, lambs to the slaughter. So at what point, I want to go to this next slide too. This shows that everyone's still pouring into the stock market. This next chart actually shows you that speculative appetite amongst retail investors is actually at an all-time high as well. This is inflows into the NASDAQ 3 times leverage ETF, which is like if the NASDAQ's up 5%, this thing's up 15. But it also works the other way around, right? If the NASDAQ is down 20%, this thing's down 60. But we have record inflows into these extremely leveraged triple leverage ETFs, which is just, again, how are they not seeing where this is going and that this is like all the ingredients for an absolute disaster? And so talking a lot about gold, Josh, and I'm sorry to go on here. I'm a little bit revved up today. This next chart, I think, speaks volumes because it's actually from JP Morgan, UBS, and Goldman Sachs. They have revised their gold price for the year to $4,500. Okay. And they're looking at 37 as being like a minimum right now. We're at 32. Okay. So that's maybe another $1,200 increase in the price of gold over the next 9 months. The only reason a bank would ever put that out there, and for the record, I've said this to Colin on the show many times, banks almost never have these types of predictions because if they think something is going up, their new price projections show going just very marginally up to keep it super conservative, right? The banks like to play it super conservative. They almost want to downplay how much they think it can actually go up by. Well, this just kind of sets in stone that everyone realizes that there's a regime change going on right now. And if the banks believe this, you better believe it's probably, not that it's exactly accurate, not that we'll get exactly there, but that it's within the realm of possibility now. And Wall Street's already kind of tuned into this. Main Street's got to turn on. They've got they're asleep at the wheel right now. They've got to realize $3,200 gold is cheap. It's cheap compared to where this stuff is going. Okay. If you want to talk about quickly where we're going, I'm going to pull up this next chart, which is my roadmap. Okay. This is my, call it, 10-year roadmap for gold. Okay. When a gold bull market commences, they typically last 8 to 10 years. We were range bound under $2,100 for 4 years, from 2020 to 2024. We just bobbed around, a little under and a little over that $2,000 mark, as low as $1,600, as high as $2,100, but we can never get over that. As soon as we broke out over that last year, we went from $2,100 to $3,200, right? We were at $3,250 just a couple days ago. This longer term bull market trajectory chart shows you that I actually think that if we see that kind of 10-year-ish mark, starting last year and lasting, 8 to 10 years, that's typically what you get out of the precious metals bull market. Gold's probably going to $8,000, $10,000, $12,000 over the next 5 to 7 years. Okay. And people, when I talk to them about this, they say, that's insane. How's that possible? I provide them with this context. In 2007, gold was the most expensive it ever was. It was $700 an ounce. Okay, roughly speaking, maybe six something. When the 2008 global financial crisis hit, of course, gold dropped a little bit, right? And that typically happens when you get a major market crash, everything gets sold, even the metals will pull back a little bit. But from the bottom of 08, in 3 years, gold tripled. It went from 600 and change to $1,900 in 3 years. And so when people call me and say, hey, gold's the most expensive it's ever been, I don't want to buy here. Okay, well, if we'd had this conversation in 2007, you would have told me the exact same thing. But with this type of, again, global macroeconomic backdrop, with things that are going on with the currency, things that are going on with the economy, things that are going on with trade, things that are going on with the bond market, things that are going on with geopolitics and global tensions, we have a setup that's probably not only going to mirror that 2008 roadmap, but actually like it could be on steroids. So for gold to potentially triple, and I'm not putting a price on it. We can't guarantee anything. It's just that there's a time and a place for gold to outperform, and it just so happens to be right now. Like it's right in front of us. So for gold to go from 3 to 8 or 10 or 12,000 over the next 5-10 years, it's not out of the question. It's not out of the question at all. Okay. It's just history, maybe not necessarily repeating, but rhyming.
Yeah, absolutely. Absolutely. I mean, it's the reality is every fiat currency that has ever existed since the beginning of time has gone to zero, right? With the average lifespan of about 60 years. So we're 100% on fiat money, right? I mean, the might of our U.S. military is what gives us the dollar reserve status, right? I mean, we don't produce anything in this country. Everything is produced outside of the United States, and then we import it in, right? And people are talking about how these tariffs are going to pay everything off. I think the tariffs are going to make everything a lot more expensive for people who have a lot less money in their pockets.
Yeah, I agree with you, man. So I think keeping that in mind. We talked about the dollar, we talked about bonds, we talked about gold. I think part of this tariff stuff that's going on is the necessity for the dollar to become cheaper and to go lower in order for us to successfully bring all this manufacturing back, which is obviously a strategic objective for Trump, right? He wants to bring a bunch of production back to U.S. soil. I think that's an amazing goal long term. But corporations like Ford or anyone else, they're not able to just rejig the global, supply chain overnight. It's going to be a multi-year process. And in order to actually have successful production here in the US, you need a cheaper dollar.
That's right.
And so, I'm not saying this from a political perspective, but sacrificing the dollar is actually one of Trump's major kind of goals. He has to do it, which is even more reason for getting some of your wealth out of the dollar, out of the stock market, out of bonds, out of strategic allocations, and into physical metals.
Yes, I absolutely agree. It's 100%. Couldn't hit the nail on the head.
Boom. All right, well, let's use that as an opportunity to go to commercial.
Talking to people today about their retirement accounts. Sir, excuse me.
Yeah.
Do you have a retirement account?
Yeah, I've got a TSP from my old government job.
How's that doing?
I'm forgetting about it. I can't contribute to it. There are fees to get the funds and the investment options are limited, so the money's just stuck.
How about a gold IRA?
I can do that?
Absolutely. You can roll it into a gold IRA and you have all the same tax advantages as a TSP, but with more flexibility. And you can put physical gold and silver in your retirement account.
I'm taking control with Noble Gold Investments.
Your retirement, your rules. Noble Gold.
All right, we're back on here, and I think we might have some questions from the viewers here. So give us a second to pull these up here. Let's go over some good questions.
So we have a question here from a viewer. In a week or so, I'm rolling my 401k into a Roth IRA. I have a chance at that point to invest in gold. Gold is still a good investment idea, right?
Josh, you want to take a crack at that?
Yeah, absolutely. So what's nice about owning metals in an IRA is that you're not limited to just gold, silver, platinum. You can do a combination. And most of our clients, they don't pick one or the other. They don't do just gold or just silver or just platinum. They do a combination of the 2 to the 3 different metals here. So when you're investing in precious metals, I think it's a very good idea to diversify while you're diversifying, right? So you don't want to put all your eggs in one basket in precious metals as well, right? I have a kind of a varied portfolio of platinum, coins, bars, gold, silver. I have all three metals and a decent amount of all three. So I would say, gold's always a good idea to invest in, right? I mean, gold's not going anywhere. There's a reason why it's been used as money and currency for the last 5,000 years, and it's held the test of time. So, I mean, you go back any time in history, gold's always a good idea to invest some of your assets in. There's no doubt.
Yeah, and I'll just add to that. Look, we talked about, 2007, all-time high, $700 gold. We all wish we could go back and buy it at that level, right? But now, same setup, but gold's 3,000 an ounce. It just shows how much the currency is depreciated, because an ounce of gold's an ounce of gold. But what's going on with the currency for the next 5, 10, 20 years? It's a similar trajectory, if probably not worse, and maybe some kind of reset. So I say this a lot to clients on the phone, like, sure, we all should have bought gold 20 years ago. We all should have planted a tree 10 years ago, but the next best time is today. So if you understand where we're at in the kind of global context of recession, debt markets, stock markets, and what that does for gold, it's frankly rocket fuel. Whether it's this week, next week, or in a month or 6 months from now, the promise of gold will always be there. And it is a absolutely crucial time for everyone to consider diversifying and acquiring some physical precious metals for themselves to protect themselves. Yeah,
If I
great
decide
question.
to invest in gold, what's a better way to make an income with that investment? Should I hold an IRA? Should I invest in vaulted gold? Which one would be better?
Yeah.
Josh, you want to go?
I was just going to say, so this is kind of a misnomer that people get with investing in physical gold and silver, the actual coins and bars. So physical metals do not care. They don't gain interest, right? It's not like you clip a coupon like a bond every year and you collect interest payments. Physical gold and silver go up in value. So you buy, let's say you bought gold a year ago at 2,000, right? And today it's at 3,200. And you go to sell the gold, and you have a 60% gain on it, right? It's not like you're getting $600 sent to your account that's extra in your account. It's just the coin or the bar that you purchase is worth an extra $600.
Right.
So I want to make sure that that's clear, right? It doesn't gain interest. It's not an interest-bearing account. You're buying gold and silver at today's price with anticipation that in the future it's going to be higher.
Exactly. Yeah, we get that question a lot. And so let's just use some, rough numbers here, just to kind of illustrate what Josh is saying a little bit more. You've got a retirement account, $200,000. You want to put 25% into physical metal, so call it 50 grand. Well, you bought from us, let's say last year, $2,000 gold. It's $3,200 now. So your $50,000 is sitting at about 75 or 80 grand. Okay. You have grown that part of your portfolio along with the appreciation of that particular asset, of that commodity. It's a physical bar or coin. It's a physical commodity. So you are growing your portfolio, you're growing your wealth, but there's not a income stream. There's not a yield. There's not actually a spin-off of any interest or cash. And when we have clients that are required to dip into a 401k in order to make ends meet every month, and I did give this example earlier, we want to know that, because we'll work with you and we'll tell you straight up, do not put everything into physical gold and silver if you rely on it for your monthly income and to make your ends meet. You want to think about physical metals as, if I can look at my portfolio and I can think of a chunk of that I don't need to touch or access for up to 2 years, I can safely put that into physical precious metals, because 2 years from now, anyone who bought from me 2 years ago is up 40 to 60%. So you do not want to overcommit to physical metals if you rely on your retirement accounts for monthly income, because they don't spin off interest. But if you have a portion of your portfolio that you are looking to protect longer term, 2 years or more, you can safely park that in gold and silver, a little bit of platinum, knowing that you're in a structural bull market for many years while everything else is probably getting hit. Okay. Josh, anything to add there? Did I do an okay job?
No, that was great. That was great. That was awesome.
What's So how do I decide what percent of my portfolio I should dedicate to precious metals? Is that different for everyone?
Yeah, absolutely. And this is probably one of the most common questions that we get here at Noble Gold, right? How much should I do in metals? How much should I leave in the stock market? And I've said this before, and I'll say it again. I always have the same response to everybody who asks me that question. It's you're asking me the wrong question. You need to be asking yourself, how much do you want to leave exposed in the stock market, exposed in the dollar? Not how much do you want to protect with gold and silver. So for some people, that's 10%. For some people, that's 25%. For some people, that's 100%. I mean, there's no real right or wrong answer for that.
Right.
I feel very comfortable. I'm probably 70, 80% of my assets are in physical metals, and I feel very comfortable.
Yeah, and mine's even higher. Like, and again, I don't recommend this for clients, but my total exposure to the physical metals markets is about 90%. I've been doing this 8 or 9 years as an investor, working here for 4. Love what I do, love the space, love the investment. I'm very passionate about how gold and silver are actually going to protect your wealth better than any other asset class. I think, frankly, they're going to be the only game in town. Within a couple of years, that'll be obvious. It might not be to retail investors right now, as we've seen. But if I'm right, you can't lose in this space. But the answer to how much is case by case, person to person. You've got to look at everything. We're not financial advisors. We cannot tell you how much. Okay. I have 2 rules of thumb. It's very similar to Josh's response. The first is whatever amount of your portfolio you can go without touching for 2 years, you can safely put that into gold and silver, knowing you're probably looking at fairly significant returns in that time frame just based on current trends and where I think we're going. The other part of it is, how much do you want to leave exposed to a crash in the dollar, a crash in the bond market, and a crash in the stock market? Those types of risks are very real, as we've talked about and as we've illustrated here today. So if you can leave it alone for 2 years or more, you can safely put that into gold and silver. But also, if it's something you want to protect and you want to make sure you're de-risking from all these other elements in the financial markets, that you can put in the physical gold and silver as well. But for everyone, there's a different answer.
Yeah.
Just call us and we'll walk you through it. And ultimately, it's up to the client.
And what happens if I invest in precious metals and later need access to that money? How does that work for me?
Sure. Yeah. So it's very common. I mean, I have a lot of clients that are taking their RMDs, also known as required minimum distributions. So once you hit 72.5, you have to start liquidating some positions in your IRA on an annual basis. It's very important, or the IRS will tax you at 50%. So RMDs hit, and what's nice with when you're in physical metals, you can take physical delivery of your metals. You're not subject to selling the metals back to cash and taking out the cash. You can take physical delivery of your actual coins and bars and pay taxes based off the spot price, which is fantastic. So a lot of my clients do that. It really depends on your situation, right? If you need the money, if you need cash and you don't need gold and silver in your hands, well, you can liquidate the metals to cash and take out the cash out of your IRA. Now that is a taxable event, so you're gonna have to pay taxes, but that's very common, right? It depends. Do you need cash today, or do you want the metals to hold on to for a future date to liquidate? Micah, you have anything to add?
I would only add, and that's bang on. I tell clients the best part about physical metals IRAs is that you can do metal or cash. Okay, with a typical IRA, you're just looking at cash distributions. So I have lots of clients that are in RMD. Like Josh said, you have to take a little bit out every year, but these guys don't need the money to pay their monthly bills. They essentially have to take the RMD so that they're not taxed any further. They know that gold and silver are going to continue to go up, but they don't actually need to sell the silver to get the cash to pay for whatever bill. So they'll pull that metal out, comes to you at home. You can put that in the safe somewhere. And even though you've actually satisfied that RMD, you have an asset that's with you physically that's going to continue to appreciate long after the RMD as well. And we'll still buy those metals back from you. If you pull them out of your IRA and they come home, and at a later date down the road you want to sell them back to us, we'll still buy them back from you, right? We'll help you ship them back to us. You can get liquid cash that way as well. So yeah, you can pull cash or metal out of your IRA really at any time.
Yeah. Great answer, Micah. And we're going to take our last commercial break. We will be right back.
Talking to people today about their retirement accounts. Sir, excuse me.
Yeah.
Do you have a retirement account?
Yeah, I've got a TSP from my old government job.
How's that doing?
I'm forgetting about it. I can't contribute to it. There are fees to get the funds, and the investment options are limited, so the money's just stuck.
How about a gold IRA?
I can do that.
Absolutely. You can roll it into a gold IRA and you have all the same tax advantages as a TSP, but with more flexibility. And you can put physical gold and silver in your retirement account.
I'm taking control with Noble Gold Investments.
Your retirement, your rules. Noble Gold.
Great. Josh, I think we got one last question, and then I've got a little bit of homework for our listeners who've made it this far. Ryan, I don't know if you've got that one last question for us.
Yep, just one last question here. If the economy continues to worsen, how can I expect my gold to stay solid?
Josh, you want to take a crack at it? I got an answer, but you go ahead.
Yeah, so historically, gold and silver do very well in times of uncertainty, in times of high inflation, in times of a weak dollar. I mean, that's no pun intended. That's where gold and silver shine, are in those environments, right? We've been in a kind of a weird environment the last few years because the stock market's gone straight up along with the price of gold, right? We've seen back-to-back years of 20, 22% in the stock market, and it's the same for gold, which historically is pretty rare. Usually when the stock market's surging, we have gold, relatively flat or weak. So, I think with the tariffs, the Federal Reserve, inflation, everything is pointing towards a strong or a weak dollar and a strong gold and silver.
Yeah.
So, I mean, it's the only way I could see gold and silver falling is if we see a huge incline or a huge increase in the U.S. dollar.
Right.
And I don't think we're going to see that.
Yeah, I basically tell people, look, my views will turn bearish on gold if we have a government with no debt, no spending, no money printing, and that's exercising fiscal restraint and austerity. And of course, we don't have that. I don't think we'll ever have that under any administration. And so, what I would add to Josh's answer is all those things: recession, weak dollar, inflation. There'll be central bank intervention, money printing at some point in time, lower interest rates. All that stuff's inflationary. All that stuff is very good for the price of gold. Now, when you have a stock market crash, like a very precipitous stock market crash, like a 2008, like a 2020 during the COVID crash, and frankly, even like the crash after Liberation Day, okay, we saw gold and prices come down a little bit. When the stock market crashes, gold and silver get sold because they're a tier one asset. So they basically get sold like with everything when people are just waiting to see what happens, get to cash before I redeploy. But in these major instances, like a 2008 or a 2001, what gets triggered is what I call like a capital rotation event. The stock market's been benefiting from inflows for years, right? And most recently, they're at an all-time high. But when the writing becomes on the wall for the retail investor that the stock market's likely going sideways or down for many years, and I think we're in that now, this is the very beginning of this phase, when it becomes obvious that that's what we're in, you get what's called a rotation of capital, where people sell their stocks and they sell their bonds and they have a flight to safety, which is physical gold and silver. And when that rotation of capital occurs is when the price goes crazy, right? Again, gold tripled in 3 years after 2008, peaking in 2011. Silver, on the other hand, went up 8.5 times in 3 years, from $7 to $50 in 3 years. So again, that roadmap that I've laid out, with all the various risks that we've identified, weak dollar, weak bonds, weak economy, we're going to see this rotation of capital occur in earnest, and we could see the stock market and the economy go down or flat for years, whereas gold and silver are going ballistic. And so, I think that that's obviously a lot of things to happen between here and there, but I remain pretty steadfast in that forecast. And I believe it. I'm invested in it. I think that's where we're going. That's why we try to help people every single day here at Noble Gold, just to understand some of these various elements. They can be complex, but this is a very simple investment format. Gold and silver are the oldest asset classes around. It's a set it and forget it, be right, sit tight type of investment. If you want to stop worrying about this and that and all the other things in the day-to-day swings, you just buy gold and silver for the amount of your portfolio that makes sense for you, and you can count on that being a wealth preservation and a wealth protection asset for still many, many years to come. So this one last piece of homework that I have, and then we'll let Josh wrap up here, let you know how to get a hold of us and stuff. But the homework that I have for our listeners that have made it this far is go and get your retirement account statement from the end of December 2024, so Q4 2024, and get that laid on your table. Sit down at your kitchen table with your spouse. Go and get your March 31st statement, so Q1 of 2025, and compare them. And the situation in the current stock market is actually worse than a couple of weeks ago on the 31st of March. But we're not kidding. 15 to 20% is what most people are going to be looking at in terms of overall losses in 3 months. Okay, so go find your statement, figure out what you're invested in, figure out what your portfolio has done over the last 3 months, and then decide for yourselves what part of that retirement account makes sense to have protected in physical metals for the long term, and give us a call.
Absolutely. Yeah. And a way to get a hold of us is you can go to our website, noblegoldinvestments.com, or you can give us a call directly here. Talk to Micah, talk to myself. We have a lot of great sales associates that can answer any questions you have, help educate you on the process, and see if this is a good fit for you. So our phone number here at Noble Gold is 877-646-5347. We look forward to hearing from all of you today.
Thanks, Josh.
Yeah, thank you, Micah. Thank you for
All right,
being with
man.
us.
See you soon. You too.